Gold touched $5,000 per ounce earlier today. Then it fell more than 3% in a single session. Silver dropped nearly 3.5%. And the catalyst was not a Federal Reserve decision, not a surprise inflation print, not a collapse in equity markets. It was a diplomatic conversation in Geneva between the United States and Iran that tells you something important about where we are in the current gold and silver cycle. It tells you that risk sentiment, not just monetary policy, is now driving capital flows in the precious metals complex. So the question you need to sit with today is this: was that 3% drop in gold a structural shift? Or was it a temporary repricing of geopolitical risk premium that accumulated too fast, too far? And what does it mean for your positioning when a metal that touched $5,000 pulls back sharply on the mere possibility of diplomacy? If you want to understand the architecture behind these moves, rather than just react to them, stay with me throughout this video. And if you find this kind of analysis useful, please subscribe and hit the bell icon so you never miss an update. Hit the like button as well. It helps this channel reach more serious investors who think about markets the way you do. Let us start with exactly what happened. Gold opened the session near $5,000 per ounce, a level it has been approaching and testing with increasing frequency. The move to that psychological threshold reflected weeks of accumulated safe haven demand, driven by Middle East military tensions, dollar softness, and growing expectations that the Federal Reserve would continue easing monetary policy through the remainder of 2026. Then reports emerged that the second round of nuclear talks between Washington and Tehran in Geneva showed progress. Both sides reportedly reached understanding on core guiding principles. That single data point was enough to trigger a meaningful repricing. Gold fell to the $4,169 area. Silver fell from near the $76 range to approximately $73.70. The US dollar index, the DXY, firmed near 97.25. The 10-year Treasury yield stabilized around 4.05% after dipping nearly 4 basis points earlier in the session. Non-yielding assets sold off. Geopolitical premium compressed. Capital rotated, at least temporarily, away from safe haven positioning. Now here is the structural point that matters most. This move did not happen in a vacuum. Gold and silver had already been under pressure from a broader reset in positioning that began in late January. Precious metals had run hard. Silver, in particular, had experienced extreme volatility, having tested levels well above $80 before a sharp multi-day correction drove it toward the $64 area in early February before recovering. The recovery itself was unstable, with silver unable to reclaim the 20-day moving average, which had descended toward $83, signaling weakening short-term momentum. So when the Iran diplomacy headline crossed, it did not land on a clean, rested market. It landed on a market that had already been digesting a significant repricing, where positioning was stretched and where bulls were defending levels rather than pressing new highs. That context matters enormously when you're thinking about whether a pullback is an opportunity or a warning. The macro backdrop is genuinely complex right now. On one hand, January CPI data showed headline inflation falling to 2.4% year over year, down from 2.7% in December. Core CPI came in at 2.5%, in line with expectations. Those numbers are directionally favorable for gold and silver. Cooling inflation, if sustained, typically clears the path for further Federal Reserve rate reductions, which lowers the opportunity cost of holding non-yielding assets. Less competition from real yields means gold and silver become relatively more attractive in a portfolio allocation framework. On the other hand, the Fed remains cautious. The market is currently pricing only a 21% probability of a rate cut in March, with nearly 79% of participants expecting rates to remain unchanged in the 350 to 3,075% range. Chicago Fed President Austin Goolsbee acknowledged this week that recent disinflation has been partly driven by base effects, and that the Fed needs clearer and more sustained evidence before easing further. His estimate of the neutral rate, the R-star, sits near 3%. That means current policy is still meaningfully restrictive. And in a restrictive policy environment, every piece of data that delays the next cut creates headwinds for gold and silver. This is the essential tension in the market right now. The structural case for gold and silver remains intact. Central banks globally purchased 863 tons of gold in 2025 alone, and forecasts suggest demand near 850 tons in 2026. Societe Generale has estimated that China alone may have accumulated up to 250 tons of gold in 2025 through trade flows, representing more than a third of total central bank demand. That is not speculative buying. That is sovereign-level strategic reserve accumulation. Meanwhile, Gold ETF inflows reached 801 tons in 2025, and global investment demand hit 2,175 tons, confirming that institutional capital is not retreating from the precious metals complex at the structural level. But none of that insulates gold and silver from short-term repricing events tied to geopolitical sentiment shifts. When risk sentiment improves suddenly, even temporarily, levered long positions unwind. Stop levels get triggered, liquidity thins, and you get days like today. The deeper structural question is what this pullback reveals about the real yield environment. When the 10-year Treasury yield sits near 4.05% and inflation is running at 2.4 to 2.5%, real yields are positive, somewhere in the range of 155 to 165 basis points, depending on the measure you use. Positive real yields are a headwind for gold in conventional modeling. They represent an opportunity cost. If you can hold a government bond yielding 4% and inflation is running at 2.4%, your real return is meaningful. Gold, which yields nothing, has to compete with that. The structural bull case for gold rests on the expectation that this opportunity cost will erode as the Fed continues cutting rates and as monetary debasement over a longer horizon makes nominal yields increasingly inadequate compensation for the erosion of purchasing power. Over a 5 to 10 year horizon, an investor in gold is not making a bet on next week's CPI print. They are making a bet on the cumulative trajectory of fiscal deficits, monetary expansion, and the long-term decline in dollar purchasing power relative to real assets. That bet is not invalidated by a diplomatic headline, but it can be temporarily obscured by it. Silver operates in a similar framework, but with an additional layer of industrial demand complexity. Silver is simultaneously a monetary metal and an industrial commodity. Its demand is supported by solar panel manufacturing, electric vehicle components, semiconductors, and advanced electronics production. In periods where industrial growth expectations are healthy, silver tends to outperform gold because it benefits from both the monetary bid and the industrial demand bid. In periods of risk-off, when growth fears dominate, silver tends to underperform gold because the industrial demand component gets discounted. The current environment sits uncomfortably between those two dynamics. The U.S. economy has shown resilient services PMI data near 53 and composite readings above 52, suggesting continued expansion. But private payrolls data has been softening, with ADP reporting only 22,000 private sector jobs added in January, well below the 48,000 forecast. That combination of service sector strength and labor market softening is not a clean signal for silver's industrial demand picture. So silver's recent weakness relative to gold reflects that ambiguity. When uncertainty dominates and diplomatic developments reduce geopolitical premium without clearly improving industrial growth prospects, silver often absorbs the most concentrated selling. Now let us think through 3 forward scenarios with clear logical frameworks, not price targets. The bullish scenario for gold and silver requires a specific combination of outcomes. It requires the U.S.-Iran diplomatic process to stall or collapse, restoring geopolitical risk premium. It requires the FOMC minutes released Wednesday to confirm a decisively dovish tilt, strengthening rate cut expectations. And it requires Friday's core PCE inflation data to come in softer than the consensus estimate, reinforcing the disinflationary trend. If those 3 elements converge, the capital that rotated out of gold today on the Iran headline would likely rotate back, and gold could reapproach the $4,900 to $5,000 range within days. Silver would follow with potentially sharper upside, given its more compressed recent performance. In this scenario, the current pullback would be seen as precisely what long-term allocation logic suggests, a liquidity-driven reduction in positioning that creates re-entry opportunity for investors with longer time horizons and sound capital preservation frameworks. The bearish scenario unfolds differently. If U.S.-Iran talks produce a formal framework or interim agreement, geopolitical risk premium in gold would compress further and meaningfully. If the FOMC minutes reveal that Fed officials are more concerned about inflation persistence than about growth risks, rate cut expectations get pushed even further out. And if core PCE comes in at or above 2.7%, the disinflationary narrative weakens sharply. In that environment, a stronger dollar, stable or rising real yields, and reduced geopolitical demand would press gold toward the $4,700 to $4,150 area. Silver, given its technical fragility below key moving averages, could test lower structural support zones. This scenario would not represent the end of the structural bull case, but it would represent a more protracted consolidation that tests investor conviction and forces significant positioning resets. The neutral or consolidation scenario is perhaps the most probable near-term outcome. Iran talks make incremental progress, but do not produce a breakthrough. The FOMC minutes confirm the Fed's patience without signaling significant hawkishness. Core PCE prints in line or slightly below expectations. In this environment, gold stabilizes in the $4,150 to $4,150 range. Silver oscillates around the $73 to $76 zone. Capital flows remain indecisive, with positioning light and conviction low on both sides. Markets await the next macro catalyst with the kind of structured patience that serious long-term investors understand well. Consolidation is not failure. In a structural bull market, consolidation is the mechanism through which new buyers enter at sustainable levels, reducing the fragility of the advance and building the foundation for the next leg higher. Let me close with the structural insight that today's session actually reinforces. Gold and silver are not simple safe haven assets in the traditional sense. They are complex instruments that reflect monetary policy expectations, real yield dynamics, geopolitical risk sentiment, dollar strength, central bank accumulation patterns, and long-term monetary debasement fears simultaneously. On any given day, one of those forces can dominate and produce a move that appears to contradict the others. Today, geopolitical risk sentiment dominated. The Iran diplomacy headline compressed safe haven demand faster than the disinflationary CPI data or central bank accumulation trends could offset it. But the central bank accumulation did not stop. The disinflationary trend did not reverse. The Fed did not change course. The long-term monetary debasement thesis did not weaken. Only one variable shifted, and the market reacted to it sharply because positioning was extended and the move to $5,000 had been fast. That is how markets work. The discipline required is the ability to separate the short-term repricing from the long-term structural thesis without panicking, without overreacting, and without abandoning a sound capital preservation framework because of a 3% single-session decline. The investors who successfully navigate gold and silver cycles are those who understand that volatility is the price of access to long-term real asset performance. It is not a signal to exit, it is the mechanism that creates opportunity. If you are positioned in gold and silver for structural reasons, today's move does not change your thesis. It tests your conviction in it. And that distinction is everything. If you found today's analysis valuable, please subscribe and hit the bell icon so you never miss a breakdown of the macro forces moving gold and silver in real time. Hit the like button as well. It takes 1 second and it makes a real difference in helping this content reach serious investors who think about markets the way you do. Drop your perspective in the comments below. Are you treating this pullback as a re-entry point, or are you waiting for more clarity from the FOMC minutes and the PCE data before committing? I would genuinely like to hear how you're thinking about your positioning right now.